In this video, we will take a look at Pat Dorsey's latest updates. We will look at his portfolio. Look at this, from Dataroma, Pat Dorsey from Dorsey Asset Management. This is a quality investor focused on competitive advantages, focused on moats, and this is a pretty concentrated portfolio. He has 10 stocks. So in this video, I will comment on the latest moves, tell you what has happened, maybe what Pat Dorsey is seeing with these companies, and I will go through specific slides, specific charts to show you what I think about these companies, and maybe it will get you more information about these companies. In case you hesitate to buy these companies, maybe this will be an additional push to help you pull the trigger. So you have a new buy called Enovis, and he, for example, doubled his position in ASML. He trimmed AutoZone and Wix.com. I mean, he is doing a lot of reallocation in his portfolio, and as always, it is very interesting. On this channel, we follow the big investors, we follow Pat Dorsey, and actually I own some of the companies he has. So that's very interesting. If Pat Dorsey, a quality investor, is buying a certain stock, maybe you want to see this stock. You want to analyze it. And it's exactly what we will do. Okay, so let's start. In case this is your first video from this channel, welcome. My name is Christophe Nour. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year, investing in quality stocks. And I clone Pat Dorsey, and I'm a fan of this investor. I have read maybe everything that is on the internet for this one, but let me just tell you what his portfolio looks like. A concentrated portfolio, and the biggest position, it was Meta Platforms at the time. Now it is Danaher. So it's not a very famous company. Actually, it's a big company that is not being talked a lot about. So he added 30% to its Danaher position. It's a family-owned company, and the stock has been doing nothing for a few years now. Since 2021, the stock has been doing nothing, but still, it's a quality company. We are talking about a market cap of $150 billion, and let me tell you what it is. In 1984, Danaher's founders transformed a real estate organization into an industrial-focused manufacturing company. Then, through a series of mergers, acquisitions, and divestitures, it's a company that is doing a lot of acquisitions, right? Danaher now focuses primarily on manufacturing scientific instruments and consumables in the life sciences and diagnostic industries after the late 2023 divestiture of its environmental and applied solution group, Veralto. So we are talking about a serial acquirer that is doing everything to grow its revenue. I mean, that's the goal of serial acquirers, right? But revenue is not growing recently. Has not been growing a lot. Since 2022, no growth in revenue. Actually, for the past few years, in 2019, the company had some debt. And now they are using all the cash flows they have to reduce their debt level a little bit. So a little bit of buybacks, a little bit of debt reduction here, no growth in revenue for a serial acquirer. You can guess why the stock did nothing. In the past, the valuation was extremely high, back to 2021, but now seems like all the problems of the company are behind them, and seems like this is a turnaround story. So this company is known for having a good management team. The valuation is reasonable right now. You have a forward P ratio of 27, not extremely cheap if you want my opinion, and a little bit complex when it comes to the industry, but I get why this big investor, quality investor, Pat Dorsey, is investing in Danaher. We will see how it goes. Now the investment doesn't look sexy, I agree with you, it doesn't look sexy at all, but it's a turnaround play about going back to growth, having some divestitures of what is not healthy for the business, and you will see what happens next. Actually, that could be quite interesting in the future, but it will not be my favorite bet in his portfolio. You have the second largest position now, that's Meta Platforms. I mean, he spotted Meta Platforms a few years ago, and he has been an investor in Facebook, Meta Platforms for a while. He trimmed the position by 1%, so almost no trimming here. I believe Meta Platforms has a lot of potential in the future, so I don't think he will change his mind on Facebook right now. The third largest position is a new one for him. That's AerCap Holdings. It's a company that is a little bit difficult to analyze. It's a company that rents planes. It's an aircraft leasing company. Yeah, they rent planes. Its activities include leasing, financing, sales, and management of commercial aircraft and engines. Inside my coaching program, we analyzed AerCap Holdings. We spent 2 hours analyzing this company to see if this was pretty interesting or not. And effectively, this company has a lot of pricing power. In a world where you will have inflation, in a world where you will still have globalization, you will need to lease some aircrafts. And they have pricing power. They have a lot of pricing power. They have the power to choose their price. And now the stock is trading at a rather cheap valuation. You have a PE ratio of 7, forward PE ratio of 8. They have a dividend yield of 1%. They have some debt, but not a big issue. That's about a leasing company, so it's normal to have these big red candles here. The problem I have with the company is the lack of sustained profitability. The profitability, the net income here, look at this. You don't have a smooth line that is up and to the right. You have revenue growth, yes, but still not up and to the right and very smooth. And you have a net income that is fluctuating. Let's put it this way. So if you look at the cash flow for this company, operating cash flow, actually you have the same chart for revenue and for operating cash flow. So if the company has pricing power, if they can continue to increase their prices, the revenue will go up, the operating cash flow will go up, and we will see what happens. But inside the coaching program, we've talked about this one, and the main problem we highlighted was this chart about the free cash flow. So it's a cyclical company. Yes, they have pricing power. Yes, they have a quality management. But if you want a quality company that will not add more anxiety to your life, something that is stress-free in your portfolio, maybe this company is not a good fit. And this could be a good fit if you think this industry will thrive. Apparently, Pat Dorsey is bullish. He added 20% to this position. So very interesting and something to monitor. By the way, if you want to join us inside the coaching program and analyze stocks together, you have a link in my description. As always, you can book a call with me. The call is completely free to see if we can work together and analyze companies together. So if you want to increase your understanding in analyzing companies, we can work together. The call is completely free. It's the first link in the description. Let me talk about the other one now. Oh, that's very interesting. AutoZone. Pat Dorsey has been a fan of AutoZone for many years now. It's a company in the auto part industry, and he trimmed the position a little bit. It's not a big trimming, right? It's 5%. So I think he trimmed a little bit the position to get the proceeds and re-inject the proceeds into other businesses, including ASML, that we will talk about just later. I own AutoZone, so I know the company quite well. It's the second largest position in my portfolio, and now it's true that the stock has been going up and we are a little bit expensive. I bought the stock here in May 2024 after a drawdown, and since then the stock has been going up and up and up and up, and we are a little bit stretched when it comes to valuation. Is this a reason to completely sell out of the position? No. Similarly to O'Reilly, these two businesses, AutoZone and O'Reilly, are most of the time under-promising and over-delivering. So even though the company is a little bit expensive right now with a forward P ratio of 24. This is a little bit expensive for AutoZone. If you look at the history, the company was trading like a little bit below when it comes to valuation. Even though you have a little bit expensive territory, this is not a reason to sell, in my opinion. Because in this kind of environment, inflation, this kind of demand, inflation in the auto parts industry, in the automotive sector, I think AutoZone will thrive. And they will continue to do massive buybacks in the future. AutoZone is a very interesting company. I've made a video about AutoZone a few days ago on my channel if you want to check it out. It's a 30-minute video about the quality and the power of buybacks. AutoZone has been buying back their own shares for many years. Actually, since 2001, they implemented a buyback program. And for the past 20 years, I mean, now we are in 2025, so it's been 24 years, they have repurchased 80-90% of their shares. So they will take advantage of the volatility. They will take advantage of the huge free cash flow generation to repurchase their shares. And I see no signs of stopping. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. So AutoZone is a leader in its category. The valuation is a little bit stretched. So maybe this is the reason why Pat Dorsey has trimmed the position a little bit, but still with a lot of conviction. A lot of conviction, it's 12% of his portfolio. Okay, now let me do a quick thing before we move on to Alphabet, because if you click on activity here, you see things that he completely sold out of. And you see that he completely sold out of PayPal and Sprout Social. I don't know much about Sprout Social, to be honest, but I know PayPal. And these were two positions at 5 or 6%. Actually, 1 quarter ago, I made a video about PayPal, about Pat Dorsey and PayPal, and I'm not a fan of PayPal. Let me spoil you the fun. I'm not a fan at all about PayPal right now, and I'm not bullish on PayPal at all. And I see the reasons why Pat Dorsey completely sold out of PayPal to buy more things, like Booking.com or ASML. You have a company that is losing in this market. The revenue growth is being reduced by a lot. The company is not growing the free cash flow that much and doing everything to repurchase as many shares as possible. So it's like a big bond that is not growing anymore with a PE ratio of roughly 10, 13, 15. So you have a company that is safe with the moat that is shrinking, pricing power that is shrinking, the take rate is decreasing, so they take a fee that is getting shrinking over time. Like in the past, the take rate was quite high, from 3% to 2% right now. So actually the moat is decreasing for PayPal. They are being eaten alive by other competitors that are more nimble, and this is a company that is struggling right now to grow again. And actually, they don't reinvest a lot in their growth. They think that they can take all their profits, all their cash flows, and put them into the share repurchasing program. So yeah, they are transforming the company to be a cannibal, a buyback machine that is not growing anymore. Look at the revenue on a quarterly basis. Since 2022, no growth in revenue. The net income, no growth in net income for 3 years now. So they are using all their cash to do buybacks. We will see if it works. But normally, cannibals, big buyback programs, we call them cannibals, companies that are buying themselves out, eating themselves. Normally, this system of buying heavily your own shares, normally this works for companies that are either stable or growing, with strong, stable cash flow generation. AutoZone is exactly in this situation. If the business is shrinking, doing heavy buybacks is horrendous to your business model. It's a big risk when it comes to capital allocation. So now you have two scenarios. If you are watching this video and you are a PayPal shareholder, if PayPal is stable in the next 5 years with stable revenue, stable net income, stable cash flow, you're safe, you're fine, and this will be seen as a good capital allocation because the business is safe, not growing anymore. So the management says, okay, we are in a major phase of our business. Let's do big buybacks. This is fine. If the business is stable, this is fine. If the business is growing, this is excellent. But now, if the business is deteriorating, so if the business is shrinking and the revenue is going down, if the net income will go down in the future, now we are talking about a huge red flag. And from what I see, this is my opinion, maybe I'm wrong on this one. From what I see, they will be either stable or deteriorating. I don't see PayPal growing again, actually, with all the competitive pressures that they are having right now. And I would say, I think they will maybe decrease their revenue in the future. You have a lot of competition, like a lot of competition in this industry. So I understand why he sold PayPal. I understand it becomes riskier when the business is not growing anymore. Let me continue with the things he bought, right? Google, he bought a little bit more, 3% more. It's 10% of his portfolio. And now ASML. ASML, I believe you watching this video, you know this company. It's a big leader in the chip industry. They are in a monopoly in the EUV market. Let me read the description in case you don't know this company. ASML is the leader. It's a monopoly, worldwide monopoly, in photolithography systems used in manufacturing semiconductors. Photolithography is the process in which a light source is used to expose circuit patterns from a photomask onto a semiconductor wafer. It's a company from the Netherlands, and it's a monopoly with extremely high margins. They have a 10-year advantage over competition, a 10-year, 20-year advantage into competition. The revenue is growing nicely. They don't have a debt problem. The operating cash flows and free cash flows are fluctuating because we are still in the chip manufacturing industry, but still growing. And now the company is doing buybacks. And if you look at the performance for the stock, the fundamentals I just showed you, the fundamentals are fine, but the stock is fluctuating by a lot. And now the stock is at the same price it was in June 2021. 4 years of zero performance, zero alpha. Any buyer of ASML is frustrated right now. And I understand this. If you look at the valuation for ASML, I'm on FinChat right now. By the way, FinChat, great website. You have a link in my description for a discount. If I look at the forward PE ratio, we are on the low end of this valuation. We are at 28. This forward PE ratio over the past 10 years has fluctuated between 22 and at the peak it was at 50. And in 2022, it was reduced at 22. Back then at 50 again. And now in April 2025, the forward PE ratio was down to 24. And I was at 27, 28. So we are not at all-time lows when it comes to valuation. Middle of the pack, on a little bit of the cheaper side maybe. People will compare the valuation metrics to the PE ratio. Look at this. Forward PE ratio. Yeah, maybe you have seen this this chart in the past, maybe another YouTube video. They will look at the PE ratio. If you look at the PE ratio, we are at 27, and this is the lowest we've had in a while. I prefer to look at the forward PE ratio because it takes into account the future growth for earnings in 2026, so next year. And we are at the middle of the pack, on the cheaper side. So it's not an extreme buy right now, I would say, but people buying ASML buy a monopoly with growing margins in a growing industry with a big AI tailwind that will come. Everything available for a forward PE ratio of 28. Not excessively cheap, but I would say fairly priced for very high quality business. And one of the few European companies that are worth buying. We are proud to be Europeans. This is one of the few gems we have in Europe. So yeah, I mean, why not? I understand people buying ASML right now, and apparently Pat Dorsey is loving this. I just recorded a video just before this one about David Tepper. And if I go to Dataroma, David Tepper here, I think he also doubled down. Oh no, I think he also owns ASML. Yeah, here we go. So you have all the big super investors buying ASML. Actually, you have a few of them. Pat Dorsey has the most conviction. You clicked on this video to have Pat Dorsey's opinion. Out of all the Dataroma super investors, Pat Dorsey is maybe the most focused one when it comes to moat, quality companies with competitive advantages. And this quality investor is doubling his position in ASML that is now 10% of his portfolio. So this is quite bullish. If I do a simple DCF on ASML, maybe you want to forecast the next 5 years of earnings. What has been the growth rate of earnings for the past 5 years of this company? This is a net income for ASML. For the past 20 years, you had the growth rate, a CAGR, compound annual growth rate of 22%. And if you look at the past 5 years, 25% growth. So this company is growing by a lot. If I look at the past 10 years, a CAGR of earnings of 20% per year. So this is very, very, very bullish. And on a conservative side, 14% growth rate. So if we are conservative and we don't think the business will grow its earnings by 20%, but let's say it will grow the earnings by 15% per year for the next 5 years. If we say they don't do any buybacks, by the way, now they are doing buybacks. So if we are being conservative, and if you think they deserve a PE ratio of 30, if these are our assumptions, the stock is cheap right now, fair value is 40% higher. And if you buy right now ASML, if this is what happens in the future, you can expect a CAGR of 18%. Maybe you see why Pat Dorsey and other quality investors are seeing for ASML. Now, if you think the business will grow earnings at 15% per year, and the PE ratio will not be 30 but will be 25, now you can expect a CAGR performance, if you buy right now, at 14% per year. Similarly, if you are more conservative and you think they will deserve a PE ratio of 20, if these are your assumptions, you can expect a CAGR of 9%. But as we've seen before, for the PE ratio, it's very rare that the PE ratio goes to 20. Now we are at 26. So if the PE ratio stays the same, if you buy ASML right now, the stock is cheap based on these assumptions. And if you buy right now, you can expect 15% per year. I completely understand people buying ASML right now. ASML right now is a good exposure to the AI industry. You will need more chips in the future. The world will be more tech-oriented in the future. ASML will grow their revenue in the future, and they will grow profitably. So the stock has dropped because of backlog, weak guidance, but this is all short-term noise, right? We all know that the world will be more tech-oriented. We all know that ASML is a monopoly. We all know that they have a 10-year advantage. We all know that the main risk for the thesis is the Chinese competitors. Every year we've seen articles about Chinese competition that will come to eat ASML's lunch. And every year, ASML is still a monopoly. So actually, right now could be a good time to start a position if you hesitate or to double down. Pat Dorsey doubling down on ASML is a very good signal. Next one on the list, 9% of his portfolio, that's Booking Holdings. Booking Holdings, actually, I like the position a lot. I like the company a lot, but I'm struggling to see the moat. I've read a lot of things about Booking. Now the stock is at all-time highs. It's big. It's been a winner, and the market cap is $200 billion. I believe you all know Booking Holdings. It's the largest online travel agency. They own many other websites, so Booking.com, but also Agoda, OpenTable, RentalCars.com, Kayak, Momondo, and this is a network company, so they make money on both sides, like Airbnb. They have a transaction take rate for every client, like you and I, that are booking hotels on Booking.com. And they are also taking a transaction fees for hotels that are putting the listing on their websites. So similarly to Airbnb, this is a economies of scale business, network effects business, and the forward P ratio for this business is 25. Revenue is growing. Look at this. Revenue is growing apart from 2020. Well, we entered the lockdown, so it's normal. People didn't travel so much. So apart from this outlier 2020, the revenue is up and to the right, net income is up and to the right, free cash flow is, look at this, up and to the right, and every year the company generates free cash flow. What do they do with the cash? They do buybacks. So they repurchase 7% of their shares, 9% of their shares, 4% of their shares. So the business model is very simple. The investment pitch, the investment thesis is pretty simple. You bet on a big website about travels that is a leader right now. You bet on this company to remain a leader in the future. They don't have a debt problem. The valuation is a little bit stretched in my opinion, but forward P ratio of 25, this is fine. You have a price to free cash flow of 20, yeah, this is fine. This is fine. Maybe a risk, if you want to continue your research on Booking.com, maybe a risk that they will face is AI search. I don't know for you guys, but for me, I am booking all my hotels and plane tickets thanks to AI. I don't browse on Booking.com anymore. I don't browse on Agoda anymore. I browse on ChatGPT. And then, when I know the hotel, the name of the hotel, the price of the hotel, the availability of the hotel, I go to Booking.com and I compare and I take the cheaper price. So, the cheapest price. So maybe Booking.com will make less revenue in the future because maybe they will have fewer ads, or maybe they will have to renegotiate the take rate. I don't know. These are questions that you have to ask when you analyze Booking.com. But from my understanding, I will not buy Booking.com at current levels. This uncertainty prevents me from buying it. But if you want to buy this one, or if you know the answer, you can comment on this video and share what you have to share with your investment pitch about Booking Holdings. These are the big question marks for this business. Apart from this, the business is fine. Apart from this, Pat Dorsey is liking the investment thesis and is adding more, plus 14% in his position. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. Now, a new buy, Enovis. What is Enovis? A starting position from Pat Dorsey, 7% of his portfolio. What is Enovis? That's the first time I see this company, to be honest. Enovis is a medical technology company that offers medical devices and services across the continuum of patient care, from injury prevention to joint replacement to rehabilitation after surgery, injury, or degenerative disease. Okay, so something in the medical industry, market cap of $1 billion. Very small. The margins are strangely negative. Forward P ratio of 8, 9. So maybe the company is very cheap. Wow, what is this? You have a revenue that is declining, that has been declining for many years, and now since COVID you have a recovery. What about net income? Negative net income. What is that? Is it a one-off expense? Yes, that's a one-off expense. Maybe something happened in the late 2024, but still the company is not profitable on a GAAP basis. Like on a official basis, the company is not profitable yet. Okay. If you look at the debt level, the company has some debt. Maybe this is part of their business model. They have leases, or maybe it's normal. You have to double check on this one. But the company has $1 billion of debt. The company increased the debt level in late 2023. Now they have $1 billion of debt for a market cap of $1 billion. So yeah, the company has some leverage. Please check what kind of leverage it is. If this is just a leasing, which is okay, or is this an actual debt? Check this if you want to continue the research on your own. If you look at the operating cash flow for this business, declining. If you look at the free cash flow for this business, negative. And they don't do any buybacks. They dilute the shareholders. Something strange that happened here in 2022. Maybe they did a divestiture of one of their big segment in 2021, 2022. And maybe this is the reason why, yeah, they cut their debt off. Yeah, I think something happened for this business in 2022. Yes, I think something happened. Maybe check on the internet what happened. But I have little information about this company. Maybe a big divestiture. Maybe a complete restructuring of this business. And maybe apparently this is a moat company, a moaty company, because Pat Dorsey is investing in this one. Pat Dorsey is only investing in companies with a competitive advantage. So maybe Enovis right now has the scale, has the advantage, first mover advantage, and now maybe they will ramp up the profitability. Maybe this is what he's seeing right now. If you had been investing in Enovis, you would have been losing money. Now we are back at COVID levels. The stock has been, wow, the company has not generated any money for their shareholders since IPO. Good luck for people that are buying right now. Apparently you have a big restructuring in a market that I have no information about, and losing money for the company and for the shareholders. So quite strange. Please do your own due diligence. And this is also the reason why we don't copy super investors blindly. Copying super investors, cloning super investors on Danaher is a very good hunting ground to check what they are doing and copy them. But you have to do your own research. I mean, Enovis, I know I will not touch it, and I will not spend precious time to analyze it, because it's not profitable, and I only invest in quality companies that are profitable, quality companies that are growing the free cash flow per share. Now for Enovis, this is not the case. Next one on the list, you have Wix.com. Wix, that was a big company for Pat Dorsey, and he cut the position by half. Too bad. So if I go to activity for Pat Dorsey, you will see Wix, and Wix has been in his portfolio for a while. And if I go and show you the stock chart for Wix, it went up a lot during 2021, and it went down a lot, and now it's rebounding a little bit. And Pat Dorsey has been trimming Wix.com. Since when, you can check this, but in 2023, he continued to trim, he trimmed again. Every quarter, he's been reducing the position. He trimmed again in 2024. He trimmed again at the end of 2024. He bought again a little bit, and he cut the position in half. Oh, he cut the position in half in Q1 2025. And again, he cut the position in half another time this quarter in Q2 2025. So in the last 2 quarters, he reduced the position by 75%. Fair enough. So he doesn't have conviction in the peak anymore. That was like 10% of his portfolio. Now it's only 2% of his portfolio. If you don't know what Wix is, I made a video about this one. I made a video with my clients. It's a coaching session where we analyzed Wix.com together, and I made this video public. It's here, live coaching call, analysis of Wix stock from May 2025. It's view on YouTube. It's a coaching call with client, what we do on our coaching program. And on this video of 2 hours, we take a look at this company. We see the reason why the stock went up massively in 2021, and now the stock is dropping down, because that's a big change for Wix. It's a big change when it comes to capital allocation decisions. So if you want to know more about this company, maybe you want to buy, maybe you want to sell, maybe you have it in your portfolio and you want to change your mind and sell it, I made a complete video about this one. So please check this one. And if you want to participate in this coaching calls, you can join my coaching program. As always, this is the first link in the description. Every week we are doing analysis like this in this coaching program. Every week we are analyzing businesses together. So I know that investing is a lonely game. You are watching this video, maybe you are alone. If you want to be part of a group, part of a community, have some advice on how to analyze companies, if you want to know how to find the KPIs for a stock and work with me directly, you have a link in the description. You can book a call with me. The call is completely free and you can participate in our next call. I'm telling you, every week we do this kind of analysis. So let me just continue and show you Wix.com. The company is quite small, $7 billion market cap. In the past, the company was a growth beast. Let me tell you what they do first. It's a company that helps you create websites. That's it. That's what they do. And you can create website as an individual, but also companies can create websites. So Wix.com is doing this. It's a Wix editor, self-creators, and it create, customize, and manage websites for themselves or for clients. And in the past, before 2022, the company was growing a lot. But the company was burning cash. Look at this, it was always unprofitable. And in 2022, the management shifted from growth to profitability. So in 2022, they became profitable. Congrats. But the revenue growth decelerated. The revenue is still growing, but a little bit slower, I would say. So before 2022, the company was diluting shareholders, financing the growth, doing a lot of SBC, stock options. After 2022, the company has stopped the dilution, stopped the costs, reduced the big marketing expenses, reduced the growth in SBC, and they are generating free cash flow. Free cash flow adjusted for SBC now. So now the company is profitable and they plan to stay profitable. So from my understanding for this business, and this is also what we talk about on this live coaching call from May, either the company grows a lot or the company is profitable. You can't have both scenarios happen at the same time. So pick your side, and management has chosen profitability. So you can expect more free cash flow in the future, but you can also expect slower growth when it comes to revenue. And the forward P ratio is 17 for this one. Price to free cash flow is 13. Yes, obviously. And maybe you will have a re-rating. If the company is not growing anymore, maybe they deserve a lower multiple, a lower PE ratio multiple. And I believe with AI, the moat for Wix.com is shrinking. Now, with AI, you have free websites on the internet, drag and drop websites, where it's very easy to create your own websites. Why would you need Wix.com to create your own website when you have plenty of alternatives now with the help of AI that can help you do the same? Wix is a renowned brand, so they will still have customers in the future. But similarly to PayPal, the moat is shrinking a little bit because of competitors. Maybe this is what Pat Dorsey is saying, and maybe this is the reason why he has been trimming Wix.com for 2 years straight to reallocate into companies with a strong moat like ASML. Okay? And the next one on the list is AerCap Holdings. Oh, it's a 2% position right now. It's a little bit of an addition. It's not a big change in his portfolio, so I will not talk a lot about this one. It's a company in the online visibility management SaaS platform. Okay, data intelligence core, AI, and yeah, it's a little bit out of my circle of competence. Please do your own research on this one. I won't spend more time. It's a company that is growing without much profits, without much free cash flows. They are diluting their shareholders a little bit every year. They don't have a debt problem. Yeah, not my kind of investment if they are not sustainably profitable. And it is only a 2% position. So I think on this video you wanted to focus on the big moves. These are the big moves. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, in this coaching program, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you have any questions, I'm here to help. Click the first link in the description below to get more information. You will get a video, a short video that explains how everything works completely for free. No need for your mail address. Just click the first link in the description and I'll see you on the other side.